Indymac is a very big savings and loan. And it failed right after the last meeting also. And this is a very significant failure. There was actually a run on the bank and they had to call in the police. I'm not kidding. This is like what happened in the 1930s in the United States during the Depression. And it's happening right now. And everyone's saying, oh, everything's fine. You know, when do you remember this happening? So this is the second largest bailout in U.S. history from the FDIC. It's the largest savings and loan bailout, second largest in total. It was not on the FDIC keeps a list of troubled banks. It was not on that list. Now, after the fact, it wound up on that list, and this is really disturbing. And I read it's not on the list, and I actually sent email to Alexander, I don't know if you can see him, and said to the guy who does the videos, and I said, just wait, it's going to wind up, it was really on the list all along. And a week later or so, news came, oh, it was really on the list all along, it was, oh, it came in the last month, and it's in, blah, blah, blah. And I said, so predictable, it was not on the list. Now, the FDIC is responsible for what goes on in the banking system and knowing if there's any problems. Now, this is the second largest bailout in U.S. history, and they didn't know there was a problem. How accurate are their other estimates of the banking system? How many other problems are out there that they don't know about? The first thing the FDIC did when it took over Indymac, it stopped housing foreclosures. This is possibly a little-known fact. And the government is determined to, just won't foreclose on all these bad loans. And I've actually heard, I've heard personally and read in a number of places that banks are not foreclosing on bad loans. They've just wait, they've stopped it, they don't want them on their books. There's $53 billion in the FDIC insurance company, and this is like if a bank goes under, you're insured for up to $100,000. Indymac will lose up around 10% of that. The estimates are $4 to $8 billion. Now, if there was a large bank failure like, say, Washington Mutual or Wachovia, one of those banks alone would wipe out the entire FDIC fund. One. And it is inevitable this fund is going to have to be bailed out. The problem is most of these institutions, the government cannot let them go under. So it has to bail them out, it has to give them money. Because the consequences would crash the whole financial system. And if the FDIC went under, people would not trust the banking system. They would take all the money out of the banks and hide it in their mattress. Throughout history, there's been many runs on banks. And they were very common before the 30s. Before FDIC insurance came out. And then not every bank failed because it was a run on the bank. If the bank was actually in solid financially, it would not fail. The easiest way you can check whether a bank is solvent is to look at its stock chart. If the stock has gone down like 90-something% in the last year, people know that's a very strong message that bank's in really bad shape.